financial independence, that's where we're going. We want to be financially independent and financially free in the money game. Now, it's important to note when you're planning your financial freedom point, the inflation, you need to include inflation into factoring what you need in the future. Why? Well, here we go. Let's say you have worked out you need £25,000 a year in today's money to retire, and that will cover all of your costs. And you have maybe a tiny little bit left over, okay? Now, if you're retiring now, that's what you need. However, if you're retiring, let's say in 5 years' time, you need to be looking at £27,600 a year. And this is just on 2%. Now, if you're Joe or you're John and you're young and you've got a plan for 35 years in advance, then £25,000 now, right? They will need at 30-year point 45,000. Okay. What happens if that 2% is doubled to 4%? Right. And then when we look at the devaluation of it, same thing, £25,000 in 5 years' time will only be worth 22,598 in today's money. It's reduced. And for John and Joe, at 30 years, that 25,000 that they have today, let's say, is only going to be worth £13,000. That's the devaluation. So it's devaluing. The numbers will be the same, 25,000, but the value that you can buy for 25,000 in 30 years' time is only £13,000. Okay. And this is what governments deem to be acceptable. Personally, I don't think it's acceptable at all. And that's why we need to plan so that this doesn't affect us. We need to be aware of this. Most people aren't aware of this. They haven't got a clue about this, to their serious detriment when they get to the point of, oh, I'm going to retire now. And they've been planning for the 25,000. And then they realize they need 45,000. We don't want any surprises or shocks like that. Okay. So, mindset. Inflation negatively impacts people's mindsets. Okay. When it's rampant, the confidence and spending patterns of people, okay, changes because fear, they'll be in a state of fear and panic because of the prices rising. That happened recently. Now, that can either accelerate the purchase in the first interim, going, oh, I've got to get everything before it all goes up, or people become more frugal. Both can have a negative effect on the economy, okay, and a serious effect on their mind because they're then reacting to, they're not working a plan out. And when you're reacting to under pressure, you rarely make a really good transactional decision. Right, so now we get on to some considerations that we need to plan in order to position ourselves well. So taxation on inflation-driven phantom profits. We talked about the phantom profits earlier. So what is it? In an inflationary environment, revenue may rise due to price increases, while costs based on older inventory or depreciated assets, they may lag. Okay, why does this matter? Well, you may, excuse me, you may show higher accounting profits, but these don't represent the real gains in purchasing power. And the tax implication, you could end up paying more tax on your unreal gains, which is why we strongly recommend you employ a professional to get the right advice about how your business works, about how you can position yourself tax-wise in an inflationary environment. Okay. So, second one, accelerated depreciation may not keep up with replacement cost. What is it? That's depreciation based on historical purchase prices, not the replacement cost of an item. Okay. Why does this matter? Well, when you replace an asset, it may cost more, but you've only depreciated the old one at the lower outdated rates. Okay. Again, an accountant will help you understand this more. I, John. Okay, bracket creep for pass-through entities and owner-managed businesses. What is it? When nominal income rises due to inflation, that's obviously, cost of goods and services go up, but tax brackets don't adjust adequately, you may fall into a higher tax bracket. This is a biggie, okay? This is a biggie. So in the UK, for the past 3 or even 4 years, there has been a tax threshold bracket freeze. Okay, so the income threshold at which you don't pay tax has been frozen. And what people don't realize is that's a tax. The mere act of freezing a tax-free threshold is a tax because the money that you earn is worth less. You need more money. So therefore, if you have an increase in your salary, you might then fall into the next tax bracket. So therefore, you pay more tax because you're in the higher tax bracket, but the money you have available, the net, doesn't buy you as much as it did 2 years ago or a year ago. And this is what we need to do when we're looking at if you're, unfortunately for people who are employed, it's very difficult to manage this unless they talk with their employers and they get the right pay rise. But for self-employed business owners and investors, they can do this more focused. And, John and I talked about this and he said when he was working with his previous firm that there weren't many, if any, and correct me if I'm wrong, John, any other business owners that would go to the level of detail of planning the increase in income required each year, not only to maintain the same standard of living that we had last year due to inflation, okay, but baking into that calculation, the increase that we receive will also increase tax. So therefore you have to increase to cover the increased amount of tax and your inflation increase before you even get a pay rise. Okay. Then you need to calculate your pay rise and including that pay rise, the calculations for the loss of value due to the 2% year on year on year on year of inflation and the increase of tax so that you actually can work out what the net value gain that you have as an increase for this next year. It's really, really important if you've got your own business, you're self-employed or an investor, that every year you have to at least keep up with inflation, okay? And that's not just 2% on because you've got the tax you've got to add to and include in that calculation. Okay? I hope that explains that one. It's close to my heart, that one, because most people really don't know that. And it's such a hidden, unfortunate stealing of value, from people. It's really underhand tactic actually by the government to freeze thresholds because all those different unfortunate effects affect your pocket and people don't really realize that. Okay, so real estate and capital gains tax planning. So what is it? Well, inflation often drives up the nominal value of property and investments, i.e. increase in price in the property or the real estate, leading to higher capital gains because you've made a higher profit. So why does that matter? Well, you may owe significantly more tax. Okay, and that needs to be mitigated legally.